From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, investors finally hear the Fed's hawkish cry, sparking a sell-off across the Treasury curve, all as bond buyers warn the easy money's already been made. We begin with the big issue, keeping up with hawkish Fed calls.
All the Fed speakers with a more hawkish tone.
Hawkish Fed rhetoric.
Pushing back hard against the concept of a pivot.
Quite a bit more nuanced.
Acknowledging that disinflation is underway.
It wasn't incrementally hawkish.
There was no added hawkishness.
Powell effectively was saying is the market isn't necessarily agreeing with our dot plot, but do you know what? I don't mind it too much.
Market's struggling with the pricing of rate cuts.
He doesn't want to pivot early.
You have to listen to them.
CPI is going to be interesting.
How sticky will inflation be around this very critical 4% level?
This number could be a spicy one on Valentine's Day.
Joining us now, Allspring's George Bory, Creditsights, Zack, Griffiths, and Erik Nelson of Wells Fargo. And Erik, you add up all the data we've gotten, what we heard from Powell and company this week, and suddenly we're looking at a 20 basis point sell-off in both the 2-year and the Treasury and the 10-year Treasury yield this week. So does that seem right to you? Is there further to go in this sell-off, or are we getting a little ahead of ourselves here?
I think the recent repricing, especially in the 2-year part of the curve, Katie, looks like a fair move to us. And I think what's different now is the Fed's reaction function has changed a little bit. For one, they're only hiking 25 basis point increments, not 50 or 75. And I think they're at the point now where they're not going to look at last week's strong jobs report and suddenly say, we have to reaccelerate to 50 or we have to do much more. I think the bar for a significant hawkish pivot is probably much higher. At the same time, though, the market is increasingly realizing that the cuts that are priced are not fair with the current data backdrop. And so I think the pricing out of cuts is really what's driving the sell-off here and the reversal of some of the moves we've seen to start the year. And that, I think, has a little bit more legs here in the short term.
Well, George, in addition to cuts getting priced out, you also see expectations for the terminal rate move a little bit higher, more in line with the Fed's projections. But what caught my eye is that you look at the options market and you're starting to see some bets on a 6% Fed funds rates, which, of course, is outside the consensus, but it is building. So we're at 475 right now on the upper bound. What would need to happen for 6% to become a possibility?
Well, you raise a lot of good points, and you know the market is, as Erik just mentioned, you know the market is basically repricing in a little bit more of a hawkish bias, and you heard it in the commentary earlier. So an extra 25 basis points has kind of basically been worked back into the market overall, and we did get a little ahead of ourselves. So you know the bond market had a nice rally to start the year. Then the data looked a little bit stronger. Next week's CPI number is going to be critical to validate sort of where is the new range. You know those outside bets that some investors are starting to sort of put on the table really has to do with the notion that inflation may not be dead yet, and that we're going to need to see materially tighter policy to ultimately get sort of inflation back down to the Fed's targets. That might be possible, but that, in our opinion, that seems to be sort of a lot further out on the horizon than we're willing to bet right now.
Well, Zack, we just heard George bring up the range that we've seen in Treasury yields, and I want to stick there for a second because I caught up with DoubleLine's Jeff Sherman earlier this week at the ETF exchange in Miami. Take a listen to what he had to say about that range.
The bond market is too tight. The Fed is too tight, and so at this stage, you don't need rates to rally to make money in bonds. Sideways from here, you make money in bonds, right? And so this idea that rates have to go down for you to make money, it's not true, especially when you have yield.
So, Zack, that's a pretty positive spin on that range-bound nature. You can still make money, but I want to talk about how this breaks. Right now, we're at about 3.7%, give or take, on the 10-year Treasury yield. The high water mark this year was 3.9%. The low was 3.3%. In what direction do you think will ultimately break out of this range?
I think we're going to remain at the top end of this range
for the next several months, at least, and our year-end call for the 10-year Treasury yield is 4%, but we kind of see that as a peak. And so when I think about the point that you can make money even if we trade sideways, that's really a big thing that underpins our view. We came into this year overweight IG and high yield credit, and we were saying to clients that 99 problems, but duration ain't one. And so when you think about where things went in 2022, we don't see another material shift higher in yields. We think range bound with 4% kind of being where we go in the next couple of months makes sense to us. At that point, we think that's kind of a buy the dip opportunity, but it's going to come down to inflation and what the Fed does. If inflation starts to reaccelerate, I think maybe that 6% bet that's happening in markets now becomes a little bit more realistic, and in which case we think that you'd see more pressure on yields, but that's not our base case call at this point.
99 problems, duration ain't one. That'll be my debut rap single. And we're going to get to duration in a little bit, but you brought up some of the other asset classes there. And what's interesting to me that even with this huge sell-off that we've seen in treasuries this week, you haven't seen too much turbulence in other markets. What does that tell you going forward? Do you think that dynamic changes and we see that volatility spill over, or do you think that rates are going to calm down here?
We think you could see some volatility over the next couple of months in credit spreads. I think it's been a really drastic move narrower to start the year, which again was consistent with our view, but seems to have moved a bit too much too quickly. And so when we look at historical seasonals, both for IG and high yield, you start to see narrowing stop or pause in February and start to widen out in March and into April. And so we think that you could see some volatility there. It's been interesting to see how well risk assets have held up, even though there has been another big dose of macro volatility with the blowout non-farm payrolls print. And what we thought were really hawkish central bank messages between the Fed, ECB, and BOE last week. It was interesting to see the initial reaction and how it's reversed over the past week or so.
And of course, when we think about macro volatility, we have a big one on Tuesday. That's the CPI print. It's also Valentine's Day. It's very romantic. But Torsten Slok over at Apollo, he put a note out this morning writing that the risks are rising, that inflation will be sticky at the 4% to 6% level and may even reaccelerate over the coming months. If inflation stays high, it will bring back the trading environment we had in 2022 because equity and credit markets will conclude that the Fed has not succeeded yet, and rates therefore need to go higher to generate more demand destruction. So, Erik, let's meditate on that a little bit. Of course, headline CPI, it's forecast to drop to 6.2% year over year from 6.5%. But walk us through just how bumpy you're expecting that path back to 2% to be.
Yeah, well, certainly the commodity price element is one of the biggest question marks, I think, for headline inflation this year. There's a lot more expectations now. You could see oil prices break a little bit higher here, particularly on the China reopening and the Russia news today. From a core inflation standpoint, I do think that there's a little bit more disinflation there. The wage picture continues to look relatively favorable for the Fed. Question is, if in the second half of the year, the labor market continues to prove more resilient, and we do continue to see some of those commodity pressures and maybe some second round effects, will the Fed start to question how much it would need to cut in a recession scenario? And the question of will there be quantitative easing? These types of questions that could sort of change the playbook for the market in a recession type scenario. That, I think, is something that's not yet on investors' radars and could come into more focus from the second half of the year.
Well, George, you think about all these big questions that investors are asking right now. This week, it turned into a sell-off in Treasury bonds. And let's talk about the dynamics of what happened, because you saw the 2s-10s curve reach negative 87 basis points when it comes to that inversion. Quite a size and scope there. That is the deepest inversion since the 1980s. What do you think exactly is driving those twin dynamics there, and how deep could that inversion go?
So inflation dominates all, as it always does in fixed income, and it's particularly acute right now. We've just talked about it with my colleagues. And as we sort of think about this year, it's both the trajectory and ultimately the pace. The question you ask is exactly spot on. How choppy is the inflation trajectory likely to be as we go forward? The next few months, it should be relatively smooth. We should see inflation coming down over the next few months. The key question is, as we get to the middle of the year, is it going to get more choppy? We think it will, and that sort of range, if you will, as inflation gets down, probably closer to 5% rather than 6%, as you saw before. But as you get down to those types of levels, it's going to become much more choppy. Now, with respect to the curve and the shape of the curve, deeply inverted is certainly, kind of the name of the game. We like a little bit of incremental duration in here as yields have kind of backed up. We think it's actually not a bad opportunity to add a little duration. But at the very front end of the curve, yields are going to remain pretty high. So having sort of a lot of income generation at the front end of the curve to us makes a lot of sense in here. Yields will go up, but they'll probably go up incrementally rather than significantly. So you'll be able to sort of offset any marginal uptick in yield. The longer end, it's got a bit of a range, as Zack mentioned, but it should be coming down as we go forward. We'll see next week. We need validation. We need to see kind of confirmation that inflation, or at least disinflation, is sort of emerging. If we get that kind of number, you could see a little bit of a mini rally. We're not giving up on the duration trade just yet. So the 2s 10s curve, could it get out to 100 basis points? It actually could. We think it could.
All right, it's a big call. We're going to keep this conversation going with George Bory, Zack Griffiths, and Erik Nelson. Everyone is sticking with us. Up next, it's the auction block. Intel and Wynn are the stars of the week as the rally starts to cool in credit. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we start with sovereigns this week. The U.S. Treasury's $35 billion 10-year note auction saw primary dealers get a record low share, with demand the highest in a year. Over in high-grade corporates, Intel was the star this week. It sold $11 billion, with orders hitting $42 billion. And in high yield, Wynn Resorts sold $600 million as part of a $7 billion total for the week. Junk, though, is heading for its biggest weekly loss in 3 months. And money managers are indeed starting to turn defensive after that sharp rally in credit. Maria Staheli of Fish Asset Management weighing in, quote, "The low-hanging fruit has been collected and opportunities and new issues are getting very close to fair value." Still with us, I'm pleased to say we have George Bory, Zack Griffiths, and Erik Nelson. And Erik, I want to start with you on that quote that we got from Fish Asset Management. Do you agree? Do you think that the easy money has already been made when it comes to the credit markets?
I think so, Katie. It's you have the two sort of countervailing forces here. One being recession and sort of risk and earnings risk, and the other being higher yields. And I think for right now, the higher yields theme is really starting to dominate, while the recession risks continue to linger in the background. So the risk reward at this point has become much more challenging. And so it's going to be hard to see the risk environment stay favorable, given the rally we've seen across assets for the next few months.
And Zack, I want to get you to weigh in on that as well. If the easy money has indeed been made, where are the opportunity in the credit markets right now?
We still see opportunity in financials. I think we came in overweight financials. Another one we liked was basics. That one seems to have moved quite a bit, especially when you consider the China reopening that happened a little bit sooner than expected, and the optimism around the Chinese economy and really the global economy. I think you've seen economic data on a global basis surprise upside a bit. So we agree with the notion that the low-hanging fruit has probably been collected, and we've been telling to shift to a tactically cautious view. We're not changing our strategic outlook. That's constructive on both IG and high yield credit, but we think that there should be some caution over the next couple months because of just how big of a move we've had to start the year.
And George, that tactical caution, I've heard it before. It's starting to make its way across the street right now. And that seems to favor income strategies. And what caught my eye in the notes that you sent over to us, you wrote that bond investors should, quote, isolate income from duration and manage the two separately. I'm hoping you can explain to us a little bit more what you mean by that.
Yeah, as you mentioned, yields are still relatively high and spreads are tight. And so, what we're trying to do is really try and compartmentalize where can you generate the most amount of income. The short end of curves still look relatively attractive. You can go up and down the rating scale. There are parts of the credit market that are looking tight. We just talked about IG credit. IG credit does look tight, but if we look at, say, securitized products, asset-backed, mortgage-backed securities, there's still some incremental value there. But we're also willing to go into high yield. We'll go into triple Bs, we'll go into double Bs, we'll even go into single Bs. There was a big rally in triple Cs in the beginning of this year. That seems overdone. These are companies that are very sensitive to interest rate costs, and interest rate costs have gone up a lot. So it's easy to sort of think about it as a beta trade, but we think it's much more nuanced than that. We can generate sort of 6.5% kind of yields at the very front end of the yield curve by sticking in kind of the Bs, triple Bs, double Bs, single Bs. These are functioning companies with good operating models, and they're paying relatively high income levels, but that, as the investor, allows you to isolate that income. Then I can use the income, I can buy duration, I can move around, I can do all sorts of things.
Right.
Sorry, go.
No, sorry, your audio cut out there a little bit, and you're touching on a question that I've been wondering, and it's pretty simple. And Zack, I want to hear you weigh in on this, which is, why would I extend duration right now? To just go to the very front end of the curve. I'm looking at one-year Treasury bills right now. They yield about 4.7%. We're talking no duration risk, no credit risk. Why would I venture out the curve? What do you see as the case for doing that right now?
Well, one risk you'd have by staying super short is reinvestment risk. If you look a year down the road and consider what the Fed may be doing, they could be cutting rates by then. And so you would have a bit of reinvestment risk in that type of investment at this point. But I think you make a great point. If you look at the shape of the curve on a yield to worst basis for credit, there's little reason to move out the curve. And like I've said, we are more comfortable getting long duration at this point, but the front end is very attractive. The curve is very flat. The Treasury curve is very inverted. But if you're basing your performance on an excess return basis, the spread curve is still fairly steep. Through the 10-year point, it flattens out to the very long end. And so depending on what metric you're using to gauge performance, we do see some room to move out the curve on higher quality stuff if you're looking to pick up that excess return with a steep spread curve.
And I mean, Erik, I want your view on this as well. What would get me out of cash right now? What's the case for moving out the curve?
Well, Katie, to be honest with you, I'm not sure there's a really compelling one. I think we're, at least in the Treasury curve, it's incredibly inverted. And we continue to see a pretty strong correlation between some of the sort of 1 to 2 year space in short-term rates relative to the 2s, 10s curve. And so as we see more of these cuts priced out, you should see that curve continue to steepen. So we're certainly on the same page as you in thinking that there's not a lot of value at the curve here in the Treasury space.
And of course, another big question is credit versus equities. And we actually heard from Winnie Cesar over at Creditsights weighing in on that topic. Let's take a listen.
We think that the credit markets can really withstand a lot of that elevated yields, especially as liquidity has returned to the market, as we've seen investors really step up and say, hey, bonds relative to equities look pretty good again. And that feels like a really good long-term trade.
And Erik, I'm going to bring that question straight to you. In this environment that we're already in 2023, what looks more attractive? Is it credit or is it equities?
Well, I think from a return standpoint, it's hard to argue for equities over credit at this point. Obviously, in a recession, sort of a looming recession scenario, you have to be careful and sort of mind your value, mind your fundamentals. But to me, it's credit over equities in this environment.
George, do you agree? I mean, obviously, there is an alternative now. That has been the rallying cry of bond bulls. But how much competition do you think there is coming from the stock market when you think about the fixed income markets?
That cuts right to the point of my prior comment, sort of isolating income versus duration. Bonds are not a growth strategy. They're not, but what they do today is they do actually generate considerable amount of income. I can use that income to invest in growth strategies if I want, but for the next couple of years, that income, particularly at the front end of the curve, looks very compelling. If I can get 4 to 6% income, that's going to do very well. Like you said, slowing economy, potential for recession, those types of returns are going to look very attractive over the next few years. But is that the forever trade? Not quite. If I want growth, I need to invest in equities. Bonds are not a growth strategy. They're an income strategy, and today's income is very attractive.
Guys, great discussion so far. Don't go anywhere. George Bory, Zack Griffiths, and Erik Nelson, everyone sticking with us because still ahead, it's the final spread. The week ahead, we have a host of Fed Speak and the big event, CPI, all on deck. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, Fed Speak continues with Bowman on Monday, followed by Barkin, Logan, Harker, and Williams all on Tuesday. And of course, the big U.S. inflation print also on Tuesday. Then we get a read from the UK on Wednesday, and finally, U.S. PPI on Thursday. Plus, of course, more Fed Speak to round out the week. Still with us, it's George Bory, Zack Griffiths, and Erik Nelson. And guys, it's time now for the rapid fire round. We're talking 3 questions, 3 quick answers. And Zack, I want to start with you. Which is more likely, that CPI surprises to the upside or the downside on Tuesday?
Downside.
George.
Downside.
Erik.
Upside.
All right, Zack, I'm coming straight to you. Does the 2s-10s curve invert, or rather uninvert, in 2023?
Yes.
George?
No.
Erik?
Yes.
All right, final question. U.S. junk spreads, they're currently around 400 basis points. And Zack, my question for you, do we get to 300 or 500 first?
300.
George?
300.
Erik?
500.
All right, guys, really appreciate it. My big thanks to George Bory, Zack Griffiths, and Erik Nelson. A great job, of course, as we count down to that U.S. CPI print on Tuesday. And, of course, as we digest all the Fed speak that we got this week, of course, Jerome Powell was the headline. And from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. And, of course, this is Bloomberg.